welcome to Market Domination. I'm Julie Hyman and Seana Smith in for Josh Lipton today. Live from our New York City headquarters, we are giving you the ultimate investing playbook to help tune out the noise and make the right moves for your money.
And here's your headline blitz getting you up to speed 1 hour before the closing bell rings on Wall Street.
This is really an opening volley by Trump to say he's really serious about tariffs. Tariffs will happen. The amount of the tariff and what the negotiation standpoint is still unknown. So this is like, hey, I'm throwing it out there. You're going to come to me. We're going to have a negotiation. We're going to try to figure out how you are going to invest more in America. And that's really what I see as the statement that Trump is making here. This is why we're looking at April and not tomorrow.
This is a stock that in 2.5 weeks went from 670 to 740. Just seemed like a runaway train almost to the upside. And it's fantastic. And I just think what's happened over the last week, I actually don't know that this is necessarily a longer term trade for many people. But I think what happened is people were looking at this and saying, okay, this is kind of insane of how fast this stock has gone up without really taking a breather. And so I think many people were just playing it for what has happened over the last couple of days and seeing, things come back to earth a little bit.
Results pretty good. They beat handily, 80 cents on the quarter, well above the 67 cent consensus view, and actually better than last year's at 74 cents. I think Oxy is doing a pretty good job at sticking to its knitting and delivering as best it can.
We got 1 hour to go until the market close, so let's take a look at the major averages, Shauna. And we don't have much change today, but this kind of continues the trend we're seeing. You just heard a couple of examples of the individual stocks that are moving more. So this continues this trend where relatively placid on the surface, but a lot of big moves underneath. So that placidness, right? The Dow barely higher, was lower for much of the session, moved a little bit higher after Fed minutes, although there wasn't really any big change of perception in the Fed minutes. Now not even up a point. The S&P up 0.25% and looks like it's going to close at a new record. It touched an intraday record as well today, and the Nasdaq up about 0.25%.
Yeah, we haven't seen too many more broad-based moves, I guess, when you take a look at the major averages, but you're right, underneath the surface, very much an earnings-driven market. We've talked about the importance of earnings into maintaining some of that momentum. The fact that we did see another intraday record high here for the S&P, of course, that points to that ongoing momentum that we have seen in the market and the ability here really for so many investors to shake off any of those concerns out there. We heard from the Fed minutes. Obviously, policymakers are still concerned about inflation. And then, of course, you have the tariff story going on. Despite all that, though, we still have this move to the upside here. Again, another record intraday high for the S&P. And that's very much, I think, has been remarkable and also reflective, really, of that ongoing improvement here in sentiment.
Improvement in sentiment and broadening, right? Like the broadening that everybody has been calling for finally appears to be happening. Today, for example, healthcare is the best performing group. Not anything to do with tech. Energy next to healthcare. Consumer staples doing well. And we've been looking sort of at the year-to-date numbers, too. And again, there you're not getting, yes, communication services helped by Meta is the top group, but then you got financials and energy that have also been performing. And if you look at the NASDAQ year-to-date, as we've also been talking pretty regularly about, if we're going to go to the NASDAQ 100, there it is. Here are some of the year-to-date returns there. Again, Meta up 20%. But the other Mag 7, it's sort of a mixed result here, which shows, again, the broadening that's been pushing things.
Yeah, very much so. And I also think when you take a look at the year-to-date returns of the S&P versus the equal weight S&P, they're not too far off. And that's very reflective of some of that broadening, the broadening trade that we have very much been waiting for now for quite some time.
Yeah, exactly.
All right, well, stocks are higher as investors weigh President Trump's latest tariff threats and minutes from the Fed's January meeting. For more, let's welcome in Adam Johnson. He's Bullseye American Ingenuity Fund portfolio manager. Adam, it's great to have you back here on Yahoo Finance. So what do you think of this momentum that we have seen in the market? We just talked about the fact that we did see another record intraday high here for the S&P, and this is coming, of course, today, despite some of those inflationary concerns that we're getting out from Fed officials.
There is far more to like than to fear. So I've been fully invested now for quite a long time. And anyone who's seen me before knows that I tend to be an optimist. I tend to be fully invested. But especially right now, I think it's a golden moment to invest in America. And I tell you why. For the first time in many, many years, we have Wall Street, Main Street, and now Washington all aligned towards growth, efficiency, fewer regulations, lower taxes. It's a wonderful, wonderful story, and it's playing out in the numbers. We've got GDP rising somewhere between 2.5%, 3%. We've got unemployment way down still at about 4%. And now we have earnings growth of 11 to 12%. There's a lot to like. So yeah, I'm very comfortable being fully invested, and all the uncertainty that we can talk about, from tariffs to rate cuts, et cetera. Honestly, none of that matters as much as the bigger picture.
You know, and it feels like the market has definitely shrugged off some of the tariff back and forth until there is sort of more concrete, bigger action. That seems to be what the market is waiting for, certainty on that front to react to here. So, you know, Adam, I know your playbook is just sort of looking at the fundamentals of companies.
Yeah.
Are you, how much are you even paying attention to macro in this environment?
I'm not. And I'll tell you why, Julie. Just look at what's happened over the past 3 months. We've had 3 one-day sell-offs of 3% or more, and within 3 days, that 3% loss was completely made up and stocks went on to make new highs. So the message of the market is that there is a ton of cash on the side that will actively and aggressively, I hate to say buy dips because that sounds so cliche, but effectively, yes, there's money that is going to come in and buy stocks. So I look at all these little sell-offs that happen from time to time. Seems like about, every 5 to 6 weeks, we get some sort of downdraft. That's an opportunity to just figure out which of your favorite names are down the most. And if you're fortunate enough to have cash and you can deploy it at that moment, that's what you buy. So I'm not worried about the big picture. And yes, as you point out, that gives me a chance to do what I love, which is to find great growth companies that have a long runway ahead of them, where I can buy them and try to double, triple, or quadruple my clients' money over the next couple of years, because I've looked at the cash flow and I've done my models and I've said, yeah, this is a reasonable multiple to put on this kind of growth, and here's where I think the stock will be in 3 years. That's my approach.
Adam, what are some of those names?
Say again?
What are some of those names?
Oh, well, one that we're all talking about certainly today, Super Microcomputer, SMCI. As I look over on the screen right now, it's up about 16%. It's been up 15 or 16% several times over the past several days. And I'll tell you what's going on there. This is a company that effectively creates platforms for artificial intelligence. They go out and they buy Nvidia chips. They go out and they buy Marvell chips and storage systems. They then go out and purchase racks and Broadcom servers, link it all up together with wire, run liquid cooling through it. Now you literally have a platform on which you can perform artificial intelligence. There was a short seller, you may remember Hindenburg Research, since out of business, that alleged the company had some accounting irregularities. That was back in October. The stock plummeted. And as it turns out, 2 weeks ago, they announced, management announced that an independent review had found no evidence of any impropriety. And as a result, the stock is rallying back. It's still, in spite of the fact that it's up, look at that, 15% today, 15% yesterday, it's still only trading at 10, 11 times earnings. An artificial intelligence company ought to trade at 25 to 30, maybe even 35 times earnings. So just on the reflation of the valuation, this stock can rise significantly. Add to that the fact that management said they're going to grow this year at 60%, and next year 65%. You just put a 25 or 30 multiple on those forward earnings. My target's 190. Again, the stock is 63 right now. We're showing it right now. So those are the kinds of companies. That's an exceptional one, that kind of growth and that kind of story, but that gets towards the type of name that I like to find for my clients.
I want to ask you a question about SMCI specifically, because as you mentioned, Hindenburg had that short report out, and a lot of people followed and shorted the stock. We had just gotten the freshest data from S3, which tracks short interest, and there is a heck of a lot of short interest still in this stock. A lot of people have been covering their shorts, obviously. Well, that was going to be my question to you. As a fundamental guy, does it bother you that this is such a speculative name, both to the up and the downside, when you're looking at the fundamental growth story?
No, because I've looked at the fundamentals, I'm comfortable with them, and now all the shorts have to cover. That's called a short squeeze. I think it's one of the reasons why the stock is up so much. And just
You
the fact
think?
that,
Yes.
so, yeah, they're getting squeezed, and it couldn't happen to a nicer group of people.
Adam, what about Nvidia? I know that was another name that you sent over, just given the valuation side of it, given the fact that it's only trading at about 30 times earnings. What does that upside then look like? And is it attractive at these levels?
Oh, yeah, it's extremely attractive. So Nvidia, again, another stock that's growing somewhere around 60%. We don't really know because they continually beat the estimates and they end up growing faster. I mean, there was a time when Nvidia was doubling and tripling earnings. Those days are over. That's why the stock tripled last year. But at this point now, it's sort of settling in. It seems funny to say that, but settling in to growth somewhere between 50 and 75%. So you think about it. You can buy the S&P 500 at about 21 times earnings, and you'll get 10, 11, 12% growth. Or you can pay a little bit more. You can pay 30 times earnings for Nvidia, and you get that 50 to 75% growth. So I would much rather pay up for an Nvidia and get that kind of growth. Google, another name that I've been telling people to buy, only trades at 19 times earnings. I mean, that's cheap when you consider the fact that Apple, Microsoft, Amazon, Meta, they all trade somewhere between 30 and 35 times earnings. And then you've got Google trading at 19. I mean, to me, that is something you got to own. Meta and Google are the only two places in the world where 2.2 billion people come together every single day. I want those eyeballs because the ad numbers and the growth are staggering. So yeah, Google's another one that absolutely people ought to be buying.
And as for Nvidia, we get the numbers from that company a week from today. Adam, it's great to see you. Thanks a lot for joining us.
Oh, thanks for having me. Love talking stocks with you.
Talk to you soon. We're just getting started here on Market Domination. Coming up, Atlanta Fed President Raphael Bostic will join the program to discuss the state of the economy as well as the central bank's fight against inflation. You don't want to miss it. Plus, at 3:30, it's the latest edition of our series Goodbye or Goodbye. We're taking a deeper dive into two stocks to help you make the best moves for your portfolio. Stay tuned, much more Market Domination coming up. It is unclear when the Federal Reserve will cut interest rates again as policymakers weigh how far Trump's tariffs could spur inflation. Fed officials have reiterated they expect to keep rates on hold while they assess the state of the economy. For more on all of this, let's send it on over to our own Jennifer Schonberger, who's joined by Atlanta Fed President Raphael Bostic. Jen?
Thank you, Julie. President Bostic, thank you so much for joining me. It's great to see you. I think the last time we were together, we were sweating in Jackson Hole, and now at least it's freezing here in Washington.
Well, it's freezing in Atlanta by Atlanta standards as well, so we're sharing the same day.
All right, well, hopefully things will heat up soon. And speaking of heating up, inflation seemed to heat up in the month of January with the latest reading on the Consumer Price Index. Producer prices came in a bit better, offering some hope for your favored inflation gauge, PCE. But given that inflation spiked in the first quarter of last year, and now we're seeing the uptick again in January, given that there was hope we would see easier comps that would provide some progress on the inflation front, to not see that now, are you worried that inflation is indeed heating up, or is this some sort of seasonality we're seeing at the start of every year?
Well, let me start by saying I get paid to worry, so I worry all the time about everything. I will say that with inflation, one of my expectations for a long time has been that we would see progress from the very high levels that we had in the middle of the pandemic, and that's exactly what we've had. And then once we got to September and we were getting closer to our 2% target, I didn't expect that the progress would go in a straight line. So bumpiness and a data point here or there that might send a different signal is not something that's super surprising to me. I think the biggest question right now is whether that data point represents a new trend or just a bump in the road. And that's what me and my team will be looking at over the next several months to make sure that we draw the right conclusion from those January numbers.
Yeah, and that January reading came before any tariffs or any changes in policy. And the minutes released from your last policy meeting this afternoon with a 3-week lag showed that you and your colleagues are worried about potential changes in policy, whether it's tariffs or immigration, and that could pose a risk to higher inflation. How are you factoring that into your outlook for inflation?
Well, look, I think that's a very good question, and I'll just say it's very difficult to factor all of these potential changes in. And I want to emphasize the word potential. For many of these policy areas, we don't have a final policy in place. So right now, we're just kind of trying to keep our eyes on the ball and make sure we understand what's going on. Until that's the case, though, I had an outlook that 2025 would proceed at a very positive level. We'd see solid growth. We'd see inflation continue to move to 2%. We'd see labor markets stay solid. Now, all this potential change, though, means that the confidence band, the precision of that estimate, in my mind, has reduced somewhat. And we'll just have to see how things play out over the next 3 and 6 months. And as we get more clarity on exactly what the policies are, then I'll have a better sense of what's going to happen in the economy. One thing I should also emphasize here is that in addition to some of the policy change that people are expecting might be inflationary, there are others that could go the other way. For example, we've heard a lot from my contacts about the prospects of deregulation, spurring a lot of investment that could increase productivity in ways that could show progress in terms of growth without putting that pressure on. So the details are actually going to matter here, and that's really what I'm going to wait to see.
I know you just said the details are going to matter here, and we need to look at the holistic picture. But to be sure, as the minute said, you are looking at these policies and think they could potentially push inflation higher, correct? Yes or no?
They could, and they could go the other way as well. It's really the whole mix because, again, I've talked to a lot of business leaders who are quite optimistic about what's going to happen on the regulatory side in particular. And they think those effects may actually swamp what happens in other areas. And so I don't want to presuppose anything at this point. As I said to start, I'm worried about everything, but I definitely want to make sure that before jumping to any conclusions, I see precisely what the policies are.
In talking with businesses on the ground, given that consumers are fed up with inflation, probably not going to be tolerant of more price increases, when we do see tariffs, do you think they will get passed on to consumers, or businesses are going to be forced to eat the majority of that? And what does that mean for the overall inflation picture? Does that get bottled up sort of in the supply chain on the business end at the expense of profits? How do you see that playing out?
Well, this is a question we've been asking everyone because the notion that there would be tariffs have been out there for a while, and we wanted to get a sense of what people are thinking. So in our surveys and in our conversations with leaders, we've asked them what are they likely to do. And what they've all said is that our first best choice would be to pass on this to the final price. But I would just say, and you noted this as well, we've already had a period of intense inflation. Consumers may not have an appetite to do that. So we will have to see sort of how that interplay occurs, and that'll really determine what the final outcome is. I do have a sense. So I talk to a lot of business leaders as well, and what they tell me is that their customers are pretty much tapped out. So there is some uncertainty about what the final landing point is going to be. I think it's actually quite different than what we saw in 2017 when we hadn't had that inflation and consumers had a little extra space to be able to take on some price.
So are you worried that you should be more restrictive now? Do you think you cut too much last year?
So I don't think we've cut too much. Look, I think we are still in a restrictive posture. That's what we need. And as inflation gets closer to our 2% target, the ideal way for our policy to move forward would be for us to get to our neutral level right at that point. That would mean we couldn't wait until we got all the way to 2% to start reducing our rate. So what we've done is appropriate. Now, of course, now we have to see sort of what that means for how the economy is going to evolve. And that's what we're doing now. It's one of the reasons why I've been really comfortable with the idea that we would take a pause and wait and see how the economy is evolving, and then use that information to guide what our policy should look like over the next several months.
Just to your point, you've said that you want more clarity on policy changes before deciding which direction to go with policy and how fast. But given that this administration is constantly going to be rolling out policies over the course of this year, what is the prospect that you remain on hold for this year entirely and that there aren't any more rate cuts this year?
So I don't have insights as to all the things that the administration may roll out. And if it is a year, then I think what would happen is that it would be take a longer time and it'd be slower for us to get all the way back to our neutral level. But I don't know what the future will hold, and I'm just going to be ready to take it on board as things happen. I do expect
So cuts
that
are
we'll
still on
get
the table?
Say that again?
So cuts are still on the table?
Sure. Everything is on the table at every meeting. I do think that I go into every meeting open to the possibility that we might take any kind of action based on what the data at the time are. So I'm not taking anything off the table. I'm not putting anything extra on the table. I would just say that we're going to let the data guide how my team looks at it. And then I'll go into the meeting with a view based on that as to what the appropriate action would be.
The minutes also noted that some officials are in favor of slowing the balance sheet or perhaps even pressing the pause button if we were to see any hiccups surrounding the debt ceiling. Are you in that camp? What are your thoughts on that? How did that discussion sort of play out within the meeting?
Well, look, first, I want to say I'm very supportive of the idea of getting the balance sheet down in size away from its emergency level. And we've made good progress on that. The reality is that as we do reduce the size of the balance sheet, we get to that threshold level. There's some threshold level where we're not going to want to reduce it any further because it'll affect volatility in money markets and other things. I think we're getting to that level, close to that level, and there's not precision on that. And given that, I think it's going to be appropriate for us to be more cautious today and moving forward than we have been in the past 6 or 8 months. The debt ceiling is one factor that comes into that, but there are others as well, including how banks decide to deploy capital across their investment instruments. So this is something I want to look at more broadly and make sure that we are paying attention day to day and make sure that we don't go too far and create volatility in the marketplace that could potentially be avoided.
And President Bostic, we'll have to leave the conversation there, but thank you so much, as always, for your insights. So appreciate it. Hope to talk to you again soon.
I look forward to talking to you, and hopefully it'll be back in the sunshine.
Yes, amen. Thank you so much. That was Raphael Bostic, president of the Atlanta Federal Reserve. Julie, back to you.
Well, and as Fed officials worry about the impact of tariffs on inflation, Fed minutes did show that officials would need to see inflation come down more before lowering interest rates further. We just heard from Atlanta Fed President Raphael Bostic talking to us about the challenge of factoring in what's going on from a policy perspective. Yahoo Finance's Jennifer Schonberger is still with us here to discuss kind of what we heard from minutes, what we just heard from President Bostic there. It was really interesting, I thought, what he had to say about his conversation with people in business and the sort of balancing effect that we could see on the economy from the threat of tariffs on the one hand, and on the other hand, the optimism that business leaders are expressing to him about deregulation.
Yeah, absolutely, Julie. I mean, the minutes clearly showed that the Fed officials are concerned that tariffs and any changes in policy could create upside risk for inflation. And Bostic acknowledged that in the interview. But when I asked him about how businesses are planning to deal with this, he said, look, we need to look at this with a holistic picture. And that's how businesses are looking at this. Yes, tariffs could add on the inflation front, but businesses are also really excited for the prospect of deregulation. And so he says that could create some offsetting factors there. So he's really going to need to look at this net. The other thing that stood out to me is, yes, they are taking a pause right now, but cuts are still on the table. They're not thinking that, hey, cuts are off the table for the remainder of this year, even as this administration is looking to go full force, and we're going to see new policies repeatedly rolled out over the course of this year.
And Jennifer, to that point, Bostic really just emphasizing how difficult it is right now, given so much uncertainty coming from D.C., whether that is tariffs, whether that is immigration, some of the things that were also noted within the FOMC minutes. And what was interesting to me, and going off of what you were just saying, just about everything being on the table, just how much more clarity policymakers are wanting. wanting and need really before they feel comfortable making that next decision.
Yeah, absolutely. I think uncertainty is the name of the game right now, and that's why officials are hitting the pause button. And you saw that also in the minutes today, very much taking a cautious approach. And Bostic acknowledged himself during the interview that he wants to take a pause here, to take a step back, see how things play out. One thing I didn't get to ask him is, depending on how long people are sort of waiting around businesses, does that put a damper on growth? We don't know. We saw a little bit of that the last time during Trump's first administration when he put more targeted tariffs on China, for example. So we're really just going to have to wait and see how all of this plays out and how other countries respond, right? Is it going to be one where, the president yesterday discussed the notion that Europe is now matching our tariffs on car imports, so now it's going to be 2.8%. That's a great outcome. Or are we going to see escalation that is going to be more inflationary? We really just don't know.
All right, Jennifer Schonberger, great interview. Thanks so much for bringing that to us.
Thank you so much for having me.
Continue this conversation. Joining us now with more reaction to Raphael Bostic and the January Fed minutes, we want to bring in Eric Rosengren. He's the former president of the Federal Reserve Bank of Boston, also a visiting scholar at the MIT Golub Center. It's great to have you here, Eric. Thanks so much for making the time to join us. So let's combine some of the commentary that we just got from Bostic as well as what we're hearing or what we're seeing from the Fed minutes. Obviously, inflation very much still a concern here amongst policymakers. They talk a little bit about tariffs, the impact that could have on inflation going forward, some of the other policies coming out from the administration. Where do you think we stand in this fight to tame inflation?
Well, I think you start with the data, and the data that we already have had has pretty much leveled off over the last 6 months. That's with both the CPI measure and the CPI data that we just got out recently that had 3% for the CPI, 3.3 ex food and energy. The PCE also has been pretty flat over the last 6 months. So as long as inflation's staying flat at levels that are above the 2% inflation target, it makes sense for them to be on pause regardless of the policy uncertainty. When you add policy uncertainty on top of that, it highlights that you really need to start seeing some improvement in the ongoing data before I think the Fed's going to be willing to seriously consider easing further.
Well, and I thought one of Bostic's interesting notes there was that not only do you have policy uncertainty potentially creating upward pressure on inflation, could potentially create downward pressure. I want to play for you what he just said and get your take on it.
I've talked to a lot of business leaders who are quite optimistic about what's going to happen on the regulatory side in particular, and they think those effects may actually swamp what happens in other areas. And so I don't want to presuppose anything at this point. As I said to start, I'm worried about everything, but I definitely want to make sure that before jumping to any conclusions, I see precisely what the policies are.
And of course, Eric, that's the challenge, right? When do we start to see? I mean, we don't even know what, all the complete suite of tariffs at this point. We don't really know the effect of deregulation. When do we start to get some clarity on any of this?
Well, we do have a little bit of clarity. We have 10% tariffs on China. 10% is not a small number. We also have tariffs on steel and aluminum. That's a significant input into car prices, for example. So we don't know how long they will continue to be at the level they're currently at. They could always be dropped. But there have been tariffs that have already been put on. Now, there are additional tariffs that are being considered. That certainly, it looks like the effect from tariffs are more likely to be front-loaded, meaning in the next 5 to 6 months, we're likely to have one, more clarity, but to the extent that more tariffs are coming on, that probably will happen in the next 6 months. I agree on the point with regulation, but regulation doesn't move very quickly. So usually it requires the regulatory bodies and to get together. Sometimes it requires legislative changes. That's much further out in the future. So that has the potential to bring prices down over time. But I think some of the inflationary policies, which would be the immigration policy and the tariff policy, are more likely to hit the economy over the next 6 months, which is exactly why the Fed should be pretty cautious before it decides to undertake further easing. So in the absence of the tariffs and the absence of immigration, I think a pretty strong case would be made that the trend for inflation would be moving down towards 2%, probably over the next 6-month period. But given the policy that's being suggested and some of the policy actions already being taken, I think it's unlikely we're going to see that much progress over the next 6 months.
And Eric, just given that and given so much of that uncertainty, how much of that do you think is really interfering or sidelining some of that global investment and then the cascading effect that that could potentially have on the economy as well?
Well, I think it affects both consumers and businesses. So in a world where you don't know whether they're going to be tariffs of a magnitude of 25% or higher, it starts affecting your decisions about what to buy now, what to buy later. And for investment decisions, before you're going to deploy hundreds of millions of dollars to build a factory, you're going to want to know what the tariff policy is and how long it's going to be in place. So if you're serious about trying to get businesses to try to open up factories in the United States, one, you have to think about even with the tariffs, does that equalize the wage differentials depending on what countries they're moving to? And I think you also have to consider whether the tariffs are likely to be permanent or not. If they're not going to be permanent, you don't build a very expensive manufacturing plant in the United States, because then when the tariffs go off, you're going to have a stranded investment in the United States. So I think this uncertainty actually is quite destabilizing, both to business decisions, but also consumer decisions on buying cars, to the extent that China and emerging markets are producing a lot of our apparel, for example. The reciprocal tariffs could have a significant effect on prices for apparel. So I think that uncertainty is likely to be a damper on growth that we would otherwise be seeing.
All right, Eric, always great to get your insight. Thanks so much for taking the time to join us here today.
Thank you.
Coming up, it's the latest edition of our series, Goodbye or Goodbye. We're taking a deeper dive into 2 stocks to help you make the best moves for your portfolio. Stick around, much more market domination still to come.
It's a big, noisy universe of stocks out there. Welcome to Goodbye or Goodbye. Our goal to help cut through that noise, to navigate the best moves for your portfolio. Today, we're taking a look at cyclical stocks, and I'm here with Genter Capital Management CEO and President Dan Genter. Dan, come on down here. Let's talk about your buy, first of all, and that is Chevron, which has been an interesting case. Like a lot of big oil stocks, hasn't really done a heck of a lot over the past year. It's up about 2%. So let's break down why you like it here. First of all, you say there is an inflection point in the free cash flow. What is driving that?
Well, what you're really seeing is that they're in a situation now to where finally their big project that they had in Kyrgyzstan is coming online. And so that was nothing but a liability. Now it's going to be something that it's going to start production. It's going to be significant contribution to free cash flow. And so it really helps them because it was a big unknown as to when that was going to come online. Mm-hmm. So it kind of is back to, they have a good international push. They have a tailwind internationally. And then obviously they're going to have a drill, baby, drill tailwind that they're going to have domestically.
Well, is that a tailwind or a headwind? I mean, because if you drill too much, then you end up getting a little bit of...
They have some adverse effect on the commodity.
Yeah,
but,
right.
but I think we have to realize that that's going to take a long period of time. I mean, even the leases are allocated. The permitting process has obviously been a delay. Even if they basically put that in place, I mean, these rigs and various infrastructure doesn't come up overnight. They're also going to have some labor shortages right now and getting people to man the rigs. So all of some additional supply it's going to be basically, there's going to be a tail to that coming on board.
Let's talk about something that's been a big overhang, right? Which has been trying to close the deal with Hess.
With Hess.
Is it happening?
We think it's going to happen this summer. And it's been a huge overhang. It's a big liability. They have huge capital commitments to it. And the fact is, the biggest thing for the stock is not an immediate increase to cash flow like you're going to have from Kyrgyzstan, but what the big deal is going to be that it fills their pipeline literally in the future. Because they're really worried, the market's worried about their properties that they have going into the future. Are you going to have these new reserves? Are you going to have this new inventory? Where is it going to come from? And needless to say, that's a massive, massive field. And as used to them to finally put that deal through and try to put some in production.
And then there's another area where we just got an announcement of a deal recently that has to do with putting natural gas power into data centers, which, as we know, has been a huge area.
Well, that's going to be huge because it's a whole AI play. So there's very few situations where literally a raw commodity energy company, utilities company is one thing, but a raw commodity energy company, an E&P company, is going to have a chance to participate in this.
Right.
So now they'll switch over to the natural gas, plugs them right into that. This is going to be major power source utilization, and they're trying to literally have a direct pipeline into it and be one of the first to the show.
Right, and they're partnering with GE Vernova to do that. But let's talk about some risks, though, on the flip side. You could potentially, of course, they're still commodity dependent, right? Even though they are relatively diversified. What's the risk that we could see a pullback in oil prices, for example?
Well, look, if more supply comes on sooner, or you have a reduction in demand because the economy, whether it's caused by tariffs or whatever happens to be, the economy slows, then anything that's going to affect that demand and commodity price, unfortunately, they're a direct participant to that.
Right.
So, and the other risk that, they really have that's just the big overhang, as you referred to earlier, is if the Hess deal doesn't go through.
Yeah. Well, they need the Exxon buy-in for the Hess deal to go through because of all of the parties' interest in the Guyana properties and offshore oil fields there. So, that's the big question.
It's a big overhang, as I mentioned, for the pipeline.
Yeah.
It's an overhang with regards to liability dissipation, and it's a big overhang. So getting it done this summer, we think that the stock is reasonably priced where it is. It's been under pressure, so you get a little pop. And if they get some domestic additional production and moving into the data center type of the business, they have a good future ahead of them. We feel at this price point.
Okay, well, so let's talk to the stock that you don't like as much, and that is Starbucks. And this is a stock that's up about 20% over the past year. Brian Niccol came over from Chipotle to run Starbucks, so there's been a lot of enthusiasm there. But you're looking at potential margin pressures here. What's behind those?
Well, what's happened is he's come over. He's a great operator from Chipotle. He knows what he's doing. He's put together a lot of initiatives and something that's been a little bit of a dead brand. And he's moving it forward, but hey, that comes at a cost. And so what you're seeing is there's some margin erosion that's taking place. So he's going to have, and that's not unusual, but you're going to have to see that he can deliver. And that basically that can go forward, he can push it, and then you're going to have to see a strong increase in what you're going to see in earnings per share based upon where the current PE is. And there's no way around that. He's going to have to deliver, and then showing that has an increase in margins, and the biggest thing is an increase in same-store sales.
And let's also talk about the operating environment. By this, you mean, in part, what's going on in Washington. The new HHS secretary coming in, RFK Jr., who is not a big fan of big sugar.
Of sugar.
Yeah.
No. And look, they've been referred to as sugar, sugar on ice. And so the fact of the matter is they may get some pressure, and you never know where that's going to go. They've been boycotted before. If that picks up momentum and people jump on that and they start boycotting those products, those are high margin products. They're way, way away from just being in the coffee business. So that has to continue to flow and has to continue to expand. And if they get a lot of pressure on that, it's going to be a roadblock for them.
And then there's where the stock is trading, which is above its historical trading range with that sort of breakout that we have seen. So do you think it's expensive then, given some of these?
It's definitely expensive.
Yeah.
It's at a 35 PE, based on what we're looking for in 25. It's relatively high on a relative basis for itself, just because, as you mentioned earlier, the stock's had a big pop, and it's jumped. And so now it's trading basically on good news. I wouldn't say it's trading to perfection, but it's trading on a lot of happiness. Maybe it's a sugar high, but now they need to produce and make it go forward.
So let's talk about what could get you back in just briefly here. If the valuation comes down, makes sense there, or you get some other types of operational or turnaround in the business.
Well, valuation has to come down. We think for us to move in and on a heavier position, the valuation has to come down, and you have to have some margin predictability. Because you don't know, is the current run rate of what they're doing with expenditure is going to be enough to do it? Or if he has to, he's going to double down, to drive the top line. Same store sales in this business is everything. So they have to be able to push it, and you're going to have margin erosion, or we want to see some predictability.
Gotcha. Okay. Well, thanks so much for being here. And just quickly, positions in either of these names?
We own Chevron. I own it. The company owns it. My family owns it. I think my dog owns it. And the Starbucks, we have it in one fund that the company owns. I don't own it.
Okay, Dan, thanks so much for being here. And thank you so much for watching Goodbye. We'll bring you new episodes at 3:30 p.m. Eastern.
Now time for some of today's trending tickers. And first up, we want to take a look at Hims and Hers Health. Those shares are soaring once again today. This time it comes after the company announced that it had acquired Tribe Labs. Now the deal will allow the telehealth company to offer at-home blood draws and more comprehensive pre-treatment testing to its users. Again, the street reacting very positively to this acquisition. You're looking at shares up just about 16% here today. You're looking at a gain of about 12% over the last 2 days. But again, what is this going to do? Hims and Hers will now offer 70 at-home diagnostics tests. It also puts them into competition with a name like Quest Diagnostics with LabCorp. But once again, Julie, this is a stock that we've talked about time and time again. Certainly has gained a lot of momentum, especially even over the last couple of weeks since the Super Bowl ad. But obviously, a lot of that recent momentum tied to their weight loss drugs and the alternatives that are out there for Novo Nordisk and Eli Lilly.
Is this stock up today so much because it bought this company?
Maybe.
Could be. But it's also up 190% this year without any actual real news. The company doesn't even report earnings until February 24th. But you know what it does have? A heck of a lot of short interest. Just like some of the other names we've been talking about, this has been fueled, at least in part, undoubtedly by a short squeeze. Once again, we have this data from S3 Partners. So the total short interest, $3.44 billion, an increase of $1.84 billion over the past 30 days. And that losses on the right there of $1.92 billion, that's the squeeze. The people who have had to cover their shorts, further driving the shares upward. So this is one of those. I mean, yes, obviously they have a business that's popular. They're the only publicly traded platform that does what they do. Does it justify a 190% increase? Well, I'm not talking 12 months. I'm talking since the beginning of 2025.
Well, exactly. And then you take a look at the 12-month chart, and that's near 600% increase, right? So that also just speaks to the staggering amount and the velocity at which we have seen the stock rise. A lot of that, you're right, is because of that short interest. And when you take a look at whether or not it can actually maintain that momentum without a significant improvement in fundamentals, that certainly is going to be put to the test.
We'll see.
We'll see.
All right, let's talk. Should we talk about dating apps now?
Let's do it.
Let's talk about Bumble. That stock getting smoked today after the company announced fourth quarter earnings, issuing a weaker than expected first quarter outlook as well, and revealing it lost 57,000 paying customers in the fourth quarter versus the third. The company also announced it would be sunsetting a couple of its apps, Fruits with a Z and Official, two apps that it had acquired in order to cut costs. And the move coming as Bumbles and others in the dating app industry have been grappling with financial challenges, prompting a reevaluation of their business strategies. As one analyst pointed out, I think the folks at Jefferies, the outlook that the company has just given implies 14 straight quarters of Bumble app revenue growth decelerating. If you look at their overall revenue growth, it's just decelerated quarter after quarter. It's been slowing.
Yeah, exactly. That line and that statistic stuck out to me. And then also the folks over at Piper Sandler saying that the turnaround is going to be choppy. When you take a look at the fact that there's no clear, I guess, conviction in terms of that direction. You talk about the fact that there's certainly been a lot of management changeover. You also have the return of Whitney Wolfe Herd. She's returning as CEO next month. And you talk about the changes that have already taken place. The company obviously has looked to cut costs. They've laid off a number of their workers within the last 12 months as well. So again, when you're talking about the fact that we've seen this deceleration in growth, obviously that's never something anyone likes, especially when you take a look at the street. And there's a lack of catalyst, I think, is the clear message that's coming from Wall Street.
You know what I always hope when we talk about this? That people are meeting each other organically in real life again.
I know, but it seems like that's happening less and less.
That's like my happy married lady, sunny view of things.
Maybe by the time our kids are looking to me, they're long last loves. That will happen.
Right, coming up, Apple has debuted its latest iPhone for a lower cost. We'll get you all the details on the other side. Stick around, much more market domination still to come.
Apple debuting its iPhone 16e. The budget-friendly iPhone includes Apple Intelligence and its first in-house designed modem. So naturally, we're calling Yahoo Finance tech editor Dan Halley joining us here at the desk. Dan, I think there's a lot to be excited about within this new product. What do you think?
Yeah, I mean, this is really kind of the predecessor to the iPhone SE line. And so that was really the kind of entry-level iPhone that Apple had for so long. They're doing away with that now, They're doing away with the iPhone 14, I believe, and now this is going to be the base iPhone that you can get. It starts at $599, which is a little more expensive than the old SE. That was $429, but you do get a lot more out of this. The phone itself, which is available February 28th, comes with the latest chip that Apple has for the iPhone 16 and 16 Plus. It's not the same one that would be in the Pro or Pro Max. It's the A18 chip. The important thing here is that enables Apple Intelligence, which is the AI platform that Apple wants to get everybody hyped on so that they'll continue to upgrade or start to upgrade more than they have in recent years. One of the other things to point out with this phone is that it has Face ID, which is Apple's facial recognition, something that wasn't on the prior SE. It also uses USB-C charging. And it has a single camera on the back, but has a kind of 2-for-1 camera option where you get a 2x kind of telephoto-like zoom on the back. It's also got a 6.1-inch OLED display, which is frankly really nice looking for a device at that price. So I think this is really something that Apple is going to be seriously pushing, and something that I think a lot of people will consider as a potential upgrade, especially now people are thinking about pricing. We're looking at the potential for tariffs and maybe an impact to phone sales there. The other major thing to point out with this phone is it's also the first to come with Apple's in-house design modem. So it's called the C1 chip, and it takes over from Qualcomm. This is all part of Apple's plan to make everything kind of in-house, so they're totally vertically integrated, and it allows them to get more power efficiency out of it, but also lets them be more flexible on the design of the iPhone. And there's talk of them coming out with a thinner iPhone next year, or I guess later this year, and potential for a foldable one down the line. The big question is, what's the performance like compared to the phones running Qualcomm's chip, and will it offer the same kind of speed and capabilities? It doesn't offer what's called millimeter wave 5G. It does have 5G, but it's just not the super duper high-end millimeter wave that other phones that have the Qualcomm chip have. So we'll just have to see what the performance is like. It's difficult to say whether it'll be an apples to apples comparison, though.
No pun intended. Let's talk about another chip, the quantum chip race. Microsoft is now out with a new quantum computing chip, and they also sort of reset the whole timing discussion around quantum. What can you tell us about it?
I want to make a Scott Bakula joke about quantum leap, but I don't know if anyone else will really get it.
I would get it.
All right, perfect. This is their new chip that they're coming out with. It's the Majorana 1 quantum chip, and essentially this just heats up the quantum chip race that we're seeing kind of break out now. Google had announced their own Willow chip back in December. The big deal with this is that it allows for more qubits to be used in the process. Qubits you can think of as kind of similar to bits on a regular chip. Those are represented as ones or zeros, but because of quantum mechanics, qubits can be both 1 and 0 at the same time. So it allows for these kind of super high-end calculations that would take thousands of years for a regular computer to process. Doesn't mean that you would plug one of these into your house. This has to be near absolute zero temperatures. It's a very specialized machine. But yeah, you're right. They did kind of talk about the timeline for when we would see practical use cases for quantum computing in the real world. Now, there was talk previously from Sundar Pichai saying 5 to 10 years, and then Nvidia CEO Jensen Huang said, well, it's probably more than that, maybe 20 years out when we'll start to see that. Now we're seeing this, back to the 5 to 10 year range with Microsoft. So look, it's truly up in the air. I think when it comes to technology, it's very difficult to predict timelines. I can say from personal experience, I was at CES, the Consumer Electronics Show, years and years ago when car companies were saying, oh yeah, 5 years we'll all be sitting in cars and, falling asleep while they drive us around.
Right.
Didn't exactly happen, so we'll just have to see.
Yeah.
We'll see what that timeline looks like. All right, Hallie, great stuff. Thanks. Well, we're wrapping up today's Market Domination. Don't go anywhere. We've got you covered with all the action following the closing bell. Stay tuned for Market Domination Overtime. We'll be right back.